Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. The firm only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability.
Welcome to Navigating Retirement with Rick Durkee.
And welcome into the program. This is Navigating Retirement, your resource for a common sense approach to planning for your financial investment and retirement future. He is the president and founder of the Coastal Financial Planning Group. Rick Durkee once again with us. Rick, welcome back in.
Hey, good morning. Good morning to everyone that joins us for our weekly podcast, Navigating Retirement. Looking forward to an informative show today on taxes. We always want to make sure we avoid taxes, not evade taxes, but avoid taxes. We're going to maybe show you a few ideas today that can help increase your returns on your retirement portfolio.
Well, Rick, I think most Americans probably think about taxes in kind of a contemptuous way and sort of only when we have to. So it seems a little odd to be discussing taxes maybe in October, but this is actually a big time for taxes. We are entering into the fourth quarter of the year, so it's really kind of our last opportunity to do some proactive planning for taxes this year. And it is time that those extensions are due is right around the corner. So procrastinators of the world unite. Today is your day.
Yeah, people might have found out that, hey, this world went away, it seems like, with the COVID situation and taxes were delayed and whatnot. But the truth is that we are at year end. This is a time that you can make some tax moves now to affect future in 2021 and beyond. So we want to talk about some of those things today.
Well, Rick, we're going to be talking about taxes. If you've got questions, ladies and gentlemen, about your tax situation, how you can better control it, how you can leverage your dollars, how you can keep more of them, how you can reduce or minimize that tax liability and bill that you'll have waiting for you into your future, pick up the phone and give a call to the team from the Coastal Financial Planning Group, 800-491-6220. That's 800-491-6220. Rick, you have talked about on the program that you really believe that the majority of Americans need to rethink the way that we are thinking about taxes.
Yeah, because as I mentioned earlier, Peter, if we look at taxes as a revenue source instead of a negative, we can look at areas where we can avoid money slipping through the cracks to the IRS and keep it in our pockets. So this could increase, dollars significantly throughout a 20 to 30 year span of retirement. So let's jump into this. I'm ready to talk about some ways that we can save our listeners some money and increase those returns on those retirement portfolios.
Absolutely. Well, Rick, most Americans have been taught to defer and delay paying taxes because we have been told we'd be in a lower tax environment in the future. Well, taxes are now lower and they could go higher into the future. How do we need to kind of reshift and program our paradigm about how we are planning and preparing for taxes?
Well, to plan and prepare means we need to have a written plan, right? That written plan needs to focus on the fact that we will pay taxes. Now in retirement, there's a big shift from the fact that we are going to move from accumulation to spend down. So our shift in tax planning will also involve some looking at the sources of income or income allocation. Where are we taking that money from? Which buckets? Is it the tax now, tax later, or tax never buckets? And so we want to make sure that we're planning that accordingly and we're not creating additional dollars that could, slip through our fingers as we go through retirement. So, it's likely that taxes are the largest expense in retirement. So we want to make sure that we factor those in our written income plan, and certainly that we avoid any blind sides, as I talked about before, anything that, could give us a quick left and knock us out, in retirement.
Yeah. And in fact, Rick, for many of us, taxes kind of have a double or triple whammy compounding effect because it's not just the taxes themselves, it's the ancillary effects that they will have on other streams of income or expenses in retirement.
Yeah, and you kind of picture that fair game called Whack-A-Mole, okay? You knock one thing down and then all of a sudden two more pop up. So taxes can be similar. Taxes that you pay or income that you bring in can actually drive taxes up in other areas. For example, your Social Security is dictated by how you take income in retirement, and your combined income formula is derived from those sources of income. So if you add up those dollars, and let's just say it like it is, when it comes to Social Security and taxation, it's everything you earn plus your Social Security benefits, everything I said, that makes your combined income or your provisional income. And if we drive that up too far, then we could be looking at a filing status that looks at maybe 85% of our Social Security benefits becoming taxable, when if we could hold that down, that income sum, we could knock it down to 50%. Now, these are all details, Peter. We're talking about things today that are tax related. Of course, we always recommend that you consult with a professional tax advisor in regards to these, but these are things that we deal with every day with our clients, especially our high net worth clients, that they're looking at, hey, how can I avoid some of these taxes or do some tax forward planning so that I can increase my returns on my total portfolio and enjoy more money while I'm in retirement?
Well, Rick, I think the IRS figured out that the longer they allow us to delay and defer paying that bill, if we get growth on our money, it's also growth ultimately on the amount that they are going to receive and collect. Also, it compounds, and our Social Security can become taxable, as well as Medicare.
Yeah,
Premiums
Medicare
are essentially income means tested. Most Americans are not hearing this. We don't receive education on it. Proactive guidance really matters in the tax planning arena to allow us to keep more of our money.
Yeah, and I mentioned that earlier about using a qualified tax professional to help you do this. Now, we can help you with the planning at the Coastal Financial Planning Group, but we want to arrange a team of financial professionals, including that tax professional, so that we can look at areas where we can do this tax forward planning and take our partner out of our business, right? Our business is our retirement. If we look at it from a P&L standpoint, we want to reduce expenses in retirement, don't we? And taxes are an expense. So that will generate more revenue for us in retirement if we can reduce those expenses. So if we meet with that competent tax professional, we certainly can look at some areas where we can do some effective income planning to take income from these different buckets that I mentioned earlier and make sure that we're getting the proper guidance to manage our income taxes. And throughout a 20, 30-year span in retirement, this can mean significant dollars. We could be talking tens of up to $100,000 over a 20 to 30-year period that we could save. So that's big money.
Pretty easily. And the more money you have, the larger that potential savings or that potential expense is going to be. Higher net worth, wealthier people make larger tax mistakes. It's just the nature of our progressive tax system. And it's not just a matter of proportional to your money, because each dollar can bump us up into even higher tax rates. It can be a significant increase in the potential expenses.
Yeah, Peter. Now, when we're looking at this again, from that standpoint of avoiding money slipping through the cracks, we want to make sure that people have that income plan in place, that it addresses taxes. It should be clearly stated there, oh, my RMD is going to start at age 72 in your income plan. We want to factor that into taxes. We want to factor in inflation into our written income plan. Taxes, if they go up in the future, could actually be a silent tax on us of inflation. So we look at all these different areas, and certainly have to realize is that taxes are going to change in retirement. It's going to be different from our accumulation years to our spend down years as to how we address income taxes.
Rick, we've had on the program previously who has been dubbed America's leading IRA expert by the Wall Street Journal, CPA Ed Slott. Mr. Slot said that we have a window of opportunity. He said taxes absolutely could go higher into the future, but we have a limited window where we can better control our tax bill. And he likened it to shopping in a department store. He said when you go in the department store, you love to see the sales racks and buy things when they're on sale, but you don't actually have to make those purchases. He said taxes are a compulsory purchase. We must buy our taxes. Why not buy them when they're on sale?
The tax sale that we're talking about could end after the election. So we might need to move fast with some tax forward planning here and take advantage of this sale. We're in one of the lowest tax rate environments in our nation's history. Secondly, when we look at the fact that we also want to plan for our required minimum distributions that we know are coming. Now they've been delayed till age 72. So some of you young retirees that are in your 60s right now, we need to look at some tax forward planning, take some money out of that actually taxed later bucket or latest bucket and move it into the tax now bucket. Pay the taxes now while they're on sale. Convert IRA dollars to Roth dollars. Use those Roth dollars to grow income tax free under current tax law, and use those later in retirement in your planning for when your income is allocated to you from tax-free dollars in the Roth. These are big strategies that high net worth people do use if they're familiar with them. If you're not, give us a call. Coastal Financial Planning Group. We do this regularly with our individual clients and also our business owner clients.
Well, the Coastal Financial Planning Group is actually going to be hosting a complete mini-series, a series of specific videos talking about the topics, the aspects, the different strategies that can help you better control and minimize your tax liability in retirement. Be sure to check that mini-series out on the website, cfpgroup.biz, cfpgroup.biz, or if you would like specific direction on how to better control your tax liability, keep more of your money in your pockets, pick up the phone and give Rick Durkee and his team a call, 800-491-6220. That's 800-491-6220. Rick, it's always a pleasure. We appreciate the time, the guidance that you share here on Navigating Retirement.
Hey, thank you, Peter. And remember that these decisions, again, need to be made now before you hit that retirement red zone when decisions have to be made. So give us a call, 800-491-6220. We look forward to speaking with you soon, and also our upcoming series on how to save more in taxes.
Catch more of Rick Durkee and Navigating Retirement by visiting cfpgroup.biz.
While we believe the information in this broadcast is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decisions. Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.